For more than 47 years, our nonprofit, Resources for Seniors, has supported older adults and caregivers in Wake County. We can help in many different ways, including adult daycare programs, ramps and repairs, in-home supports, and consultation and referrals. Indeed, we're who to call when you're not sure who to call. Resources for Seniors stands ready to support you in your caregiving journey.
I'm Mark Costley, the founding attorney of Clarity Legal Group, the Triangle Area estate planning and elder law firm. You know those people who become overwhelmed dealing with the multiple challenges of being a caregiver? Clarity Legal Group helps people establish legal tools that avoid confusion, give them peace of mind, give them asset protection, and in some cases help them qualify for Medicaid. We help people get it right in the face of some of life's most important challenges. We don't just provide wills, trusts, and powers of attorney. We provide solutions and ongoing support. We provide clarity and peace of mind. It would be a privilege to help you.
Are you like 80% of seniors who would like to age in your current home? Call Wisdom Senior Care. Are you currently taking care of a loved one and finding yourself frustrated, tired, and even lonely? Call Wisdom Senior Care. Always available, dependable, and flexible. Come partner with Wisdom Senior Care, keeping wisdom at home.
This session is all about how to pay for long-term care. We're bringing on 3 amazing guests that are going to help you navigate that journey. And now we're going to talk to Ron Heath. He's going to help us demystify the reverse mortgage and how that may be able to help your loved one pay for long-term care and remain in their home longer.
Hi everybody, it's very nice to see you here today, and we look forward to helping you appreciate how you might be able to fund long-term care during your retirement years. My name is Ron Heath, and I am going to talk to you a little bit about reverse mortgages. Reverse mortgages are an interesting concept. They certainly have been around for many decades, and what we're finding is that many people are able to use reverse mortgages to help them fund long-term care both in the home and outside the home. So what I'd like to do is just start by telling you a little bit about reverse mortgages. They are a mortgage. It's just that simple. The difference between a reverse mortgage and a traditional mortgage that you're used to having is that a reverse mortgage, when the money is borrowed, never requires you to make any mortgage payments back on the loan. So it's kind of like a home equity line of credit with no debt service, no obligation to repay the loan. So FHA became involved in the reverse mortgage program in about 1988, and since then it has been a federally endorsed program. It certainly has many, many safeguards and regulations that help to protect the consumer. I'll tell you a little bit how it works, how you qualify. The way a reverse mortgage works is it's a program limited to a homeowner that is 62 or older. They will qualify based on their age, the home value, interest rates, and then the lender will determine how much they can borrow against their home and use these funds however they might need them. Today in particular, we're going to talk about using them for long-term care. The homeowner would have to qualify based on some criteria because we want to make sure that while they have the program, they're able to maintain their obligations that they have during the program. And so some of these obligations are, one, they have to live in the home as a primary resident, so that would involve the majority of the year being occupying the home. They would also need to make sure that they continue to pay their property taxes on time, maintain homeowners insurance. If they have homeowners association dues, they want to make sure that those are always paid on time. FHA also has minimum property standards that they would expect the homeowner to keep the house up to, and so they would want to maintain the property properly during their lifetime. Other qualifying factors that we would look at, the expressions that FHA uses are willingness. So we would review the payment history of a borrower to make sure that they show a willingness to pay their bills, to pay their taxes, their insurance, HOA dues, and other obligations. We also, too, want to confirm that they have what FHA refers to as the capacity financially to be able to take care of these obligations. So we do review income. We want to make sure that while they're able to pay all of these property charges, they also have residual income that would allow them to care for the other needs that they have in retirement. So that's the short of how a reverse mortgage works. Some of the really key factors about the program that are really interesting to those that use it is one, the program, when the funds are accessed in this program, they are tax-free funds. So they are not reported to the IRS as income. So that's a big benefit to the availability of these finances through a reverse mortgage. Other things to keep in mind too are that the homeowner never relinquishes title to the home. There's a big misconception that if somebody uses a reverse mortgage, they no longer own their home, that the bank has some sort of ownership interest, and that's just not the case. As I said at the outset, it's just a mortgage, which means that the lender has a lien against the property that will be satisfied at some point in time in the future. Having said that, that means if somebody uses a reverse mortgage for long-term care within the home, and we'll talk about some scenarios in the future in just a minute about that, but if they decide at some point in time that it's time to transition from the home permanently, then they can do that. They can sell the property, satisfy whatever they may have borrowed, and the interest that's accrued on that through the sale proceeds, any net sale proceeds would be theirs to carry on to their next living arrangement. The other thing to remember too is that because FHA insures these loans, the homeowner can never owe more than what the house is worth. Now, on paper, the debt could exceed the value of the home, but because these are non-recourse loans, the homeowner has no personal liability for the repayment of the debt. So if the term we use is, if the loan ever goes underwater, the homeowner's not responsible for that. They're able just to walk away from the loan without any negative impact on them. The homeowner also should know that they can never be forced to leave the home. One thought or misconception is that, well, if I get a reverse mortgage and I use all of the proceeds, what happens? Is the loan terminated? Do I have to leave the home? No. The answer is no. Even if you exhaust the money that is made available through the reverse mortgage, you have the right to live in the home until you pass. The non-recourse provision, too, that we talked about earlier, where you never owe more or you're never obligated to pay back more than the home is worth, that is also a protective measure that passes to the heirs in the future so that a borrower who uses a reverse mortgage will never leave a hardship for their heirs. The last thing, too, is as long as the homeowner is making the payments on their taxes, their insurance, any HOA due obligations that they have, they will never, ever, ever have to leave that home during their lifetime. So that's how the reverse mortgage works. There are more details, and certainly the nice thing about these mortgages is if you were to speak to a professional that does these, you are also required to go through a counseling session with an independent party where they too will educate you about the program, the pros and the cons, how it works, and what your obligations are. So certainly that's a very good protective measure. Now, at the outset, I said we're going to talk about how reverse mortgages are being used in the ability to provide long-term care, both in the home and perhaps out of the home. So I'll share just a few scenarios with you about how this works. The first one is perhaps we have a 62-year-old couple. They own their home free and clear without any mortgage debt on it whatsoever, but they've never purchased long-term care. At 62, they're most likely quite healthy, and they are able to secure long-term care, but where are they going to get the funding for that? Many people will choose to set up a reverse mortgage line of credit from which they'll draw down funds to make the annual premium payments on their long-term care. This way, they are not impacting their perhaps fixed income cash flow, and they're not drawing down on their retirement savings to pay for this care. They're actually using this home equity, and again, without the responsibility to repay what they borrow. Another situation could be, again, a 62-year-old couple. They own their home, but they have an existing mortgage that they're making monthly mortgage payments on, perhaps a $1,500 principal and interest payment on a monthly basis. They can use the reverse mortgage to pay off this traditional mortgage. They no longer have to make that mortgage payment, and now they have additional cash flow on a monthly basis that they too could turn and use to pay long-term care insurance premiums. So some really great situations where we can see a reverse mortgage providing this protective care for the future need that may arise. Another situation that I've personally seen is if you have perhaps a 70-year-old couple. Maybe their health has failed somewhat, so qualifying for long-term care may not be a reality for them, but they own their home free and clear. They could establish a reverse mortgage line of credit that they could then use in the future to pay for health care in the home, perhaps pay for, if one spouse has to leave the home, health care outside of the home. The interesting thing about these lines of credit is that they're not stagnant. So let's say, for example, this 70-year-old couple owns a $300,000 home. Well, they're going to qualify for a line of credit that's worth about $150,000, $160,000. That line of credit, if unused, will continue to grow in value to them at a 3.5% to 4.5% annual increase. And that's irregardless of what the home value does. So we can see that perhaps in 10 years at the age of 80, they now have a line of credit that's worth $220,000, $225,000, certainly a nice resource to be able to go to for long-term care. So that's an excellent situation where we see this reverse mortgage being used to provide for what might be future needs for care in the home. Another scenario could be that we have perhaps an 85-year-old widow. She now, because of deteriorating health, needs to bring someone into the home to help her, or perhaps she needs to make some changes to her home so that she could age in place properly. A reverse mortgage line of credit is an exceptional option at that point in time. She's able to establish this line of credit, borrow as she needs to make corrections to the home so that she can age in place. But more importantly, she has access to funds should she need to start bringing care into the home. Whether it's just assistance or even more of a medical need, she has this resource to help pay for that. And oftentimes what does happen is mom or dad is being cared for by a child, and the parent, because of the onset of perhaps dementia or Alzheimer's, has lost this mental competency to be able to care for their own finances. FHA allows for a relative who is acting as an attorney in fact or a power of attorney to actually initiate this reverse mortgage on behalf of their parent, so that they then have this line of credit, this additional resource to be able to fund the care for mom and dad. And so we see that oftentimes. Sometimes it's done proactively. More often, though, we see that it's done as a reaction to a medical need that has occurred. Mom is leaving the hospital after an experience, and now they need to figure out how to fund this long-term care. And so we would encourage that everyone, both the homeowners, the parents, as well as the children, take the time to really educate yourself about this reverse mortgage option. Understand how it works, understand the protections that it can provide, and perhaps take the proactive step to be able to establish one of these lines of credit so that it can benefit them in the future, and you already have this structure in place when that medical need arises in the future. So when we think about a specific example of somebody that really needed to help mom with a reverse mortgage to make sure she could stay in her home, because that's what she wanted, I think of Edna. She, at the time I met her, had already lost one leg to diabetes. Her daughters were caring for her. One of them actually had to quit her job to be able to stay with her mom because they just didn't have the finances to hire in-home health care. Mom also, too, had a little bit of a mortgage left, and so they were having money going out that way to care for the mortgage so they didn't lose the home. So we were able to establish this reverse mortgage for her. It was a line of credit that they then used as they needed to. What was interesting was it allowed the daughter to go back to work. Mom eventually lost a second leg. She only lived about 3 more years, but the beauty of it was for those last 3 years, there was no concern about being able to have somebody in the home to care for mom. Mom also had the joy of knowing that her daughters now had a lightened responsibility when it came to taking care of her. So I feel like, at least in that story, the use of the reverse mortgage, being able to meet this woman, beautiful woman that she was, we were able to bring a sense of peace to her in the end so that she knew all of her care could be taken care of without it being such a impact on her children. So I hope that information helps you understand reverse mortgages a little bit better, understanding how they work, and understanding really how they can be such a fabulous tax-free resource, if you will, for that home health care that may occur in the future.
And now Bill Comfort is going to talk to us about long-term care and how we can use that benefit to help pay for our loved ones' care in the future.
When considering using long-term care insurance to pay for your care, I like to think of LTC in long-term care insurance to stand for Look to Claims. So I want to focus on what happens with long-term care insurance at the time of claim. And there's really two aspects to long-term care insurance in terms of planning for your care. If you are buying long-term care insurance or interested in buying long-term care insurance, you have to plan ahead. You must be healthy enough to buy or to qualify for the insurance. So you can't wait till you already need care to buy the insurance on your own life. Also, if you're looking to buy long-term care insurance, don't overbuy. The key thing is to start with home care. Start with enough long-term care insurance to cover a meaningful amount of home care, even part-time home care, that can take a significant burden off your spouse, your partner, your kids, or other loved ones in your life. Most people who buy long-term care insurance should be looking at a benefit amount that covers, again, a meaningful amount of home care and enough coverage along with your other income to help you afford alternatives like assisted living or memory care. And absolutely work with an independent broker who not only represents multiple companies, but in today's marketplace represents multiple different ways of buying the insurance, from the traditional type of long-term care through the newer types of hybrid or linked benefit long-term care insurance. You want to work with a broker who represents all of the options for you to consider. Now, let's look at what happens at claim time. If you're going on claim, or perhaps you have a family member who needs care, who has long-term care insurance, and you're beginning to wonder if and when you might start the benefits or how it works, perhaps you're struggling with getting claims paid right now. I want to spend a few minutes to help you understand how long-term care insurance works from a claims perspective. Absolutely make sure you have a full and complete copy of the actual policy. You may have to request a duplicate from the insurance company, but have that whole copy of the policy in hand so you can read all the provisions. And then understand the three biggest challenges, or the three key claims provisions as they come up in qualifying for benefits and using the insurance. Number one, benefit eligibility. Think about this as a disability type of a policy. Nothing happens with a long-term care insurance policy until you're benefit eligible. In other words, until the disability or the impairment has reached a qualifying level. And it's either or, one of two different tracks, if you like. Either you need physical help, what we measure with the activities of daily living, or you have a mental or a cognitive impairment or limitation. We'll look at each of those in some detail here. So one of the most common things people think of are these physical activities of daily living. And in long-term care insurance, there are 6 activities of daily living, physical activities, which are measured and used to determine whether or not your claim eligible yet. Transferring, which means getting in and out of bed or a chair. Toileting, which includes safely and carefully getting to and from and on and off the toilet, and of course maintaining hygiene. Bathing, which includes safely getting in and out of a tub or shower. Dressing, eating, and continence. Long-term care insurance can begin to pay a benefit if you need help or lose the ability to independently do any two of these 6 activities. Now, you don't have to be flat on your back in a hospital bed, unable to do anything. That certainly would qualify. In fact, if someone simply needs to be standing by to make sure you're safe when you perform these activities, that standby assistance to make sure you're safe is enough of a threshold or amount of help to qualify you for benefits under the physical activity trigger with long-term care insurance. Now, a little bit of a caution. If you're already getting home care, particularly, or considering getting home care and have long-term care insurance, and you're starting at this lower level of care need or impairment, and it's a standby assist just in case, make sure your care providers in the home are charting, making note of the fact that they are there as you do a couple of these activities on that standby basis. Oftentimes, caregivers don't put a note down that they helped you with dressing or transferring if they are not physically picking you up, what we call hands-on assistance. Again, standby help is enough to start the process, and that needs to be charted to help make claims go smoothly. So that's one track or one way you could qualify for benefits. Separately is what's called a cognitive or a mental impairment or limitation. We measure it through standardized tests of short or long-term memory, your awareness of your own self, where you are in place or time. Are you aware of safety issues? Can you make good decisions about your own care and safety? So often someone, particularly with early stage dementia or Alzheimer's, for example, they just need supervision. They just need someone around to make sure they're safe getting through the day. And that's enough. That supervision to make sure you're safe is enough to begin a long-term care insurance claim under this cognitive impairment eligibility. Now, most policies, all policies issued since the late 1990s, pretty much require that your need for supervision be 24/7. Not that somebody has to have their eyes on you every moment, but that the concern about safety or decision-making could be required at any time. In other words, somebody needs to be around all the time. Now, it doesn't have to be a professional. You don't have to have 24/7 home care or be in a memory care facility. It could be that your spouse or your kids help for 8 or 16 hours a day, but you then need to use the insurance to bring some aides or helpers in for a few other hours in the day. That would qualify for that continual supervision requirement. So the second thing to be aware of after benefit eligibility is what's called the policy's elimination period. Think of this as the deductible. This does not start until you're benefit eligible. So those benefit eligibility criteria, those impairment criteria we just looked at, come first. Once you're eligible, needing help on at least a standby basis with at least 2 of those physical activities or supervision for a cognitive or mental limitation, that's benefit eligibility, and the elimination period or deductible can begin. It's usually stated as a number of days. 90 days is probably the most common that we see. Now, it's not based on how much money you spend. It's really a period of time based on how long you have been benefit eligible or are actually receiving care. And that's where we need to be careful. This is especially critical if your use of your insurance is starting at home. How does the insurance company count the days in your elimination period? And let's say, for example, it's 90 days. Calendar days is easy. They just count the number of days since you were determined to be benefit eligibility. That's the simplest and the best. It's also the least common. The most problematic for home care, and also the most common provision, is what's called service days. The company only counts days where you paid for actual care. So if you hire a home care aide only 3 days a week during your elimination period, it'll take 7.5 months to accumulate your 90 days. So you really have to understand how your policy works as you begin to hire care. Now, there are some policies that give you a credit. If you get one paid day of care in a week, they'll give you credit for all 7 days in that week, and that's a little easier to navigate. And a lot of policies, particularly in the last 10 or 15 years, just simply have 0 days for home care, first day coverage. This will be stated in your policy, and a good agent or advisor can help you understand. The third provision to look at is to understand what's covered. Look at the contract language. Look at the schedule page. If the policy's facility only, if it only names nursing homes and assisted living, it will not pay for home care. Even under an alternative negotiation, it's only going to cover care in a facility. So if you're looking to hire home care, you need to make sure the policy covers home care. And when home care is covered, look at what the policy defines. Most policies that cover home care will cover an agency, a caregiving agency that's licensed by the state. In North Carolina, home care, even private duty, private pay, non-medical home care agencies have to be licensed. So they will meet the criteria in nearly every policy. Some people want to hire independently. They just want to hire an individual person. It may be covered, but it's not common, and that can be shown in your policy and is a limitation you need to be careful of when you're contracting with long-term care insurance. So when do you get your first money? How does it work if you need care? You're benefit eligible. We've started the elimination period clock running, which could be 90 days or maybe a little longer. And then after the 90 days, you pay for care and the policy reimburses you, pays you back for the care that you have paid for. So you have to pay for care first, submit your bills to the insurance company reviews it, makes sure it's covered, and then they pay the benefits. So after the 90 days, it could take another month or two for you even to get your first check. It's not uncommon for people with a 90-day elimination period to have to wait 4 or 5 months to get their very first benefit check. So make sure that that's in your plans. If you need help, reach out to a geriatric care manager who has experience with long-term care insurance or a long-term care insurance specialist that should be able to help you, even if it's time for a claim for you and your family. A final thought, if you're working with your own long-term care insurance or you're looking at a policy for a parent or another loved one, particularly if it's an older policy, mid-1990s or older, and especially if the policy only names nursing homes. Could be that it was nursing home only. Don't give up on other opportunities, particularly other facilities like assisted living or memory care, residential memory care. A lot of companies on those older policies are allowing for alternative facility payments like assisted living or residential memory care under the nursing home only definition that are in some of those older policies. Again, read the contract carefully, but don't assume that it won't pay. Also, don't assume that the first answer from the insurance company's claims department is the final answer. A lot of claims departments deal with hundreds of different types of policies, contracts, different series of contracts, so it's not always very clear. Read the policy, ask for some third-party professional help, and don't assume that it won't cover what you'd really like or need for yourself or your loved one. There could be some opportunities to expand what the policy might pay for.
Next, we're going to talk to Jonathan Williams from Clarity Legal Group. He's going to help us understand the Veterans Program Aid and Assistance benefit that will help pay for your long-term care for your loved one.
Hi, my name is Jonathan Williams, and I'm going to be talking about Medicaid. Medicaid is by far the largest payer of long-term care costs in this country. Medicaid is a federal program. It's administered through the states, and it covers nursing home care in North Carolina. I'm going to talk about different factors that we as attorneys consider when we're helping families plan for Medicaid eligibility. You see some there on the slide now: medical need, income, countable resources, community spouse rules, and gifts. The first is medical need, and I want to be clear that Medicaid covers skilled care and above. Medicaid, the traditional long-term care Medicaid program does not cover assisted living, does not cover independent living, doesn't cover home care. It covers skilled care in a facility, typically a nursing home. So those are the kinds of patients that we're considering for Medicaid eligibility. The next factor is income, and it's important to note the way that Medicaid works. When someone qualifies for Medicaid, their obligation as the Medicaid recipient is to pay their income to the nursing home, to the facility. And what Medicaid does is it pays the balance of the bill. It pays what you're not able to pay from your income. So while there is no income cap for long-term care Medicaid, there's no limit above which you can't receive Medicaid. There are some folks who have income that's high enough that they can pay for long-term care out of their income, and if that's the case, then there's nothing left for Medicaid to pay. So there are some folks who don't need Medicaid for that reason. Countable resources is another factor. I'm going to get back to that in just a second. Community spouse rules, I want to get you familiar with the terminology here. A community spouse in Medicaid lingo is the spouse who is not the one in the facility. This is the community spouse living at home who is healthy. So there's some rules that protect the community spouse from having to be completely impoverished while their spouse is in the facility and on Medicaid. And then lastly, the factor here would be gifts, and that's a reference to the 5-year look-back rule, which many people are familiar with, and I'll get into some details about that as well. But let me start next with countable resources. And Medicaid has a resource limit. The resource limit is $2,000 for an applicant, but not every asset that an applicant owns is going to count against that resource limit. As you see here, there are some resources that are not countable against that limit. First of all, your primary personal residence. Almost $600,000 in equity in a primary personal residence is non-countable against the Medicaid asset limit. That also applies to tangible personal property inside the home. So things like furniture and jewelry and those sorts of things are also non-countable. Other real estate interests are also non-countable. Sometimes they are countable. Those rules can get a little complicated, and I won't go into those details here, but some other real estate interests can be non-countable. A Medicaid applicant is also allowed to own one vehicle for transportation that is non-countable, even if they're not able to drive it. But if there are a second or third vehicle, Medicaid will not count the value of the most valuable vehicle, but the other vehicles would be countable. There are some life insurance policies that will be non-countable, particularly life insurance policies that don't carry a cash value, like a term policy and most group policies. For policies that do carry cash value, there's a face value limit of up to $10,000 that can be non-countable. But if your policies are valued above that limit, then the cash value of those policies would be countable. There are other assets that are non-countable, including Medicaid-compliant annuities and Medicaid-compliant promissory notes. If you have an annuity, you almost certainly don't have a Medicaid-compliant annuity unless you know it, because these are financial instruments that are built for the purpose of applying for and qualifying for Medicaid, and it's not the sort of thing that a regular consumer would own. And then finally, a prepaid funeral or cremation contract, if it is irrevocable, is also non-countable for Medicaid purposes. Well, with all these non-countable resources, what are countable resources for Medicaid? Well, essentially everything else. And mostly we're thinking here about other types of financial assets, including retirement accounts, including cash accounts like checking and savings accounts, also including brokerage accounts or other investment accounts. And the resource limit, as I mentioned before, is $2,000 for a Medicaid applicant. If the applicant has resources that are greater than that value, then they're not going to qualify until they've spent down below that limit. Now, the community spouse, the healthy spouse who lives at home, has their own asset limit, and that's on a sliding scale. The maximum allowed now is about $128,000 for the healthy spouse living at home. Let me talk now about the 5-year look-back rule. That rule was put in place to prevent people from gaming the system in a particular way. Before this rule was in place, folks could give all their assets away to their children, and now they're below the asset limits, and then they could turn around and apply for Medicaid and get the benefits. Lawmakers decided that was unfair, and so they instituted this 5-year look-back rule. And the way that it works is, when you apply for Medicaid, the Medicaid worker will look back 5 years and ascertain whether or not you've made gifts to help qualify for Medicaid, and to the extent you have done so, they will assess a penalty period. And what that means is, even though you qualify for Medicaid financially, they will not pay the benefit until you've served out that penalty period. And you've got to make other arrangements, typically relying on other family members to help pay those costs until you've served out the penalty period. There are some exceptions to that. You are allowed to transfer assets to your spouse without penalty. You are allowed to transfer assets to disabled children without penalty. And of course, if your spouse has died and passed assets by will, and then you need to apply for Medicaid, the fact that your spouse made gifts through the will is also non-countable. And there are also exceptions for gifts that are made for other reasons. So gifts for Christmas gifts and birthday gifts and those sorts of things are also not countable. But the Medicaid caseworker will presume that any gift was made for the purpose of qualifying for Medicaid. And you've got to overcome that presumption when you apply for the benefit. The other factor that I haven't mentioned yet is the estate recovery program. And this is the source of there's a common myth out there that if you apply for Medicaid that you're going to have to get rid of your house or sell your house. This is where that comes from. As you've seen already, you can apply for Medicaid and receive Medicaid and still own a home. But the estate recovery program is when the Medicaid program will come in after your death and present itself as a creditor in your estate. And if you have assets in your estate that are subject to creditor claims, then they may have to be sold to pay back Medicaid for the costs that they've laid out during your lifetime. So this is where sometimes families have to sell the residence because the residence is subject to a claim like this. So Medicaid presents a claim against the estate. Now, if there is a surviving spouse, Medicaid has traditionally waived that claim because they don't want to have to impoverish the surviving spouse who has to continue living their life. Now they have changed the rules. The rules now actually say that that claim is only deferred until the end of the surviving spouse's life, and then Medicaid will attempt to collect. I leave the waiver still in our slides with a question mark there because there are many elder law attorneys in this state, including myself, who really have some doubts that the state will be able to assert such a claim so long after the Medicaid recipient's death. But nevertheless, there are some rules there about surviving spouses. But our general planning strategy is to find ways to make sure that assets are passing to family members and other beneficiaries without passing through the estate and being subject to those kinds of claims. So this is another planning consideration that we take as well. One takeaway I want you to have from this presentation is that you shouldn't wait to plan for Medicaid. Just like you shouldn't wait to apply for long-term care insurance or look into reverse mortgage as an option, you also shouldn't wait too late to think about Medicaid eligibility and what kind of planning steps you can take. We already know there's a 5-year look-back rule, and because of that 5-year look-back rule, we do have the opportunity to make gifts right now if we expect that we won't need to apply for Medicaid within the next 5 years. So that is one planning opportunity. And then, of course, reconfiguring how assets are owned, perhaps converting assets from countable to non-countable is the kind of planning that can take a few weeks or months to carry out. And so the further ahead you can begin planning, the better the outcome can be. And our goal here is to help our clients get eligible for Medicaid as quickly as possible and preserve as much as the law allows them to preserve while still getting the benefit. Now, having said that, I don't want you to come away from this presentation thinking that it might be too late to plan, because there are always things that can be done to protect assets in the context of Medicaid planning. So even if you didn't plan 5 years in advance, even if you didn't plan 6 months in advance, you still have the opportunity to plan for your assets and spend them down in a way that can be smart instead of wasteful. You have the opportunity to protect assets from estate recovery, protect real estate, and so there are things that can be done before you file that Medicaid application to help your family. A couple of programs within Medicaid that I want to make sure people are aware of. The first here is the Unmet Medical Needs Allowance. This deals with the possibility that there may be a Medicaid applicant who has older medical bills that they have been unable to pay. They incurred them when they weren't on Medicaid, but now they're on Medicaid and they're having to pay their income to the facility and they have no way to pay these bills. The Unmet Medical Needs Allowance allows that person to use their income instead to pay those bills, and in that case, the Medicaid program will then cover the whole cost of the nursing home bill instead of just the portion above the applicant's income. So that's a great program that can allow you essentially to get Medicaid dollars to subsidize your payment of these old bills. That's a great program you should know about. Next is the Community Spouse Resource Allowance. I said before that the healthy spouse who's living at home has his or her own resource limit. That's on a sliding scale from about $25,000 up to about $128,000. It's a complicated formula that they come up with, but planning in advance with good planning, you can maximize your community spouse resource allowance and get it closer to the higher amount and further away from the lower amount, which anybody would want. Finally, there's the minimum monthly needs allowance, and that's a way for a healthy spouse who's living at home who has a smaller income to allow some of his or her spouse's income to be allocated to them so that they can continue to pay bills at home while their spouse is in the facility having to pay some of their income to the nursing home. So that's another good program to know about. There's another program I want to tell you about that's very similar to the long-term care program I've been describing. This is called PACE Medicaid. PACE Medicaid is a way to use Medicaid dollars to stay at home and live at home. So this is a great program. It's not for everyone, but it's for folks who would otherwise need to be in a nursing home but can live at home with the proper supports. PACE is built around a daycare model. So people who are enrolled in PACE go to the PACE Center during the day, not every day, but multiple days per week typically, and there they see their doctors, they see their therapists, they have social activities and meals, and then they come home in the evening, and there is some limited in-home care provided by PACE to help them at home in the evening. Not round-the-clock care, not overnight care, but some in-home supports to help that person live at home while they're able to live at home. And while they're enrolled in PACE, PACE covers the entirety of their care needs, including medical care, doctor visits, hospitalizations, medications, medical equipment, dental and vision, and all these things, including transportation to and from the PACE Center and to and from other doctor visits that have to happen. So it is a great program for people who are able to stay at home and want to stay at home but need Medicaid dollars to help make that work. We're a big fan of the PACE program at our law firm. And the eligibility and all these other rules that we've been talking about are very similar for PACE Medicaid as they are for the traditional long-term care program that I talked about at the beginning. Finally, I want to mention a couple of other programs that are not Medicaid, but you do need to have them on your radar if you're thinking about applying for government help to pay for long-term care. The first is the VA Aid and Attendance Benefit. That is a veteran's pension for wartime veterans or widows of wartime veterans. If there's financial need and need for aid and attendance, meaning additional medical support in the home or even non-medical support in the home, then the VA can pay a pension to that veteran. There are eligibility rules, and you've got to apply for it, of course, but that's a good program. And then finally, there's the State County Special Assistance Program. This is a state-run program that is very similar to Medicaid, and it covers assisted living care. I said earlier, Medicaid only covers nursing home care and doesn't cover assisted living and below, but special assistance does cover care in an assisted living facility, including memory care. Because it's only state dollars and not federal dollars, it's harder to get eligible. It's not funded as well, so there are going to be fewer people who can qualify. But for people who can, of course, it's great to be able to get that help from the state to help pay those costs. So thank you very much for joining us as we talked about how to pay for long-term care in these different contexts. I also want to thank Ron and Bill, my co-presenters. If you have any questions about any of these things, of course, we'll have a Q&A period, or you can reach out to any of us individually or to Transitions Guiding Lights, who can put you in touch with us or other experts who can help you with these issues. Thank you very much.